Namaste and welcome to a presentation on capital budgeting involving replacement decisions. This is an illustration number 12. It is focusing on replacing an existing machine which involves additional installation cost of the machine, and also selling the old machine, which results in normal gain as well as capital gain. And the illustration states company pays 55% on normal income and 30% on capital gains. And the company is having a cost of capital of 15% for the sake of discounting. And we are given two streams of inflows in respect of after-tax profits when we continue with the existing machine or when we sell it off and then go for a new machine. This is simply talking of what is the impact on the income flow under each of the streams. We are looking into the problem under two broad heads: existing machine and new replacement machine, and cash flow at the beginning of the project, that is year 0. Let us take one by one. A chemical company is considering replacing an existing machine with one costing 65,000. We are showing an outflow of 65,000. The existing machine was originally purchased 2 years ago. Let us understand this: 2 years ago, and it was purchased for an original cost of 28,000 2 years ago, and is being depreciated by straight line method over its 7-year life. Its life is 7 years, 2 years is past and 5 years is future. For 7 years, 28,000 distributed under straight line method, annual depreciation is 4,000. It has already covered 2 years, means the depreciation charged is 8,000. Therefore, written down value as of this year is 28 minus 8 is equal to 20. It can currently be sold for 30,000. You need to note here now, its original cost is 28,000. It is being sold at a value of 30,000, means above original cost. Anything that you earn above original cost is a capital gain. And anything that you earn within the original cost, because today written down value is 20,000, up to 28,000, that 8,000 is normal gain. The moment it crosses 28, that is a capital gain. Knowing this, let us proceed further. It has to be sold for 30,000, means in year 0 we receive 30,000 rupees with no removal costs. Net amount we receive is 30,000. The new machine would cost 10,000 to install. We are installing at 10,000 rupees. There is an outflow of 10,000 and would be depreciated over 5 years. Now this is past is 2 years, balance is 5 years. New machine also matches the future of 5 years and would be depreciated over 5 years. The management believes that the new machine would have a salvage value of 5,000. Means at the end of 5 years, we will have a salvage value of 5,000, means we have to recover 75 minus 5, 70,000 over 5 years. Therefore, our annual depreciation in respect of new machine will be 70,000 divided by 5, 14,000. And the management also estimates an increase in net working capital requiring 10,000. Means we have to put in more current assets and there will be an outflow of rupees 10,000 towards increase in working capital for expanded operations with the new machine. And the problem says the firm is taxed at the rate of 55% for normal income and 30% for capital gains. Let us see its implications. What is normal income? If you sell something within the original cost is 28,000 and WDV is 20,000, 8,000 is the normal income. And if you sell above 28,000, the difference between sale proceeds and original cost is 2,000, which is called capital gains. Now, to repeat once again, an asset whose book value of 20,000 has been sold for 30,000. Therefore, there is a net profit of 10,000 as compared to the original cost. It is split into two. Sale proceeds in excess of original cost is capital gain. Sale proceeds 30, original cost 28, therefore 2 is capital gain. And original cost minus WDV is the normal income. And the problem says normal income is charged to tax at the rate of 55%. Means on this 8,000, company has to pay a tax of 4,400, means that is an outflow. And on the capital gains of 2,000, we have to pay a tax of 30%. Therefore, 30% of 2,000 is 600. Means effectively, when we sell the machine for 30,000, we will end up paying a tax of 5,000. Therefore, our net inflow when we sell the old machine is 25,000. And coming to replacement machine, we have paid 65,000. There is an installation charge of 10,000 and additional working capital of 10,000. And we have spent 65 plus 10 plus 10, 85,000. Outflow of 85,000 for a new replacement machine. Whereas for an existing machine, when we sell it, we receive 25,000. And the net effect of this entire decision is company receives 25,000, company pays 85,000, net outflow is 60,000, which is net investment or incremental investment. 85,000 minus 25,000 is 60,000 is the net investment. Having seen the implications in terms of inflow and outflow on sale and purchase, now we are going to take the income stream under both proposals. Under existing machine, it says we will be receiving 2 lakhs in the first year, 1,50,000, 2,10,000 and 2,20,000, all totaling to 9,60,000 up to 5th year of operations. And we normally go for cash flow under income stream. Cash flow is nothing but PAT plus depreciation. Now the problem gives us the PAT, that is profit after tax. And with the new machine, 2,16,000, 1,50,000 up to 2,30,000 till the 5th year. 10,36,000 is what we receive. And to derive the amount of cash flow, we post the depreciation. We have seen depreciation in respect of the existing machine is 4,000 rupees. We post that amount for the 5 years. 2 lakh, 2 lakh 4,000, 150, 154, 210, 214, 220, 224. That way, PAT for 5 years, depreciation for 5 years, and individual years, what is the inflow. This is from our working in respect of existing machine. Second, we go for the new machine. Depreciation in respect of new machine is 70,000 divided by 5 is 14,000. We post that 14,000. And we were also told the company will get 5,000 as a salvage value in the 5th year. We put 5,000 as inflow. And once we close a project, this project is for 5 years. At the end of 5 years, The machinery is salvaged and whatever is there in the system is taken back. What is there in the system? We had put 10,000 as additional working capital. That will be recovered. When we brought this machine, we brought in additional 10,000, and when we close this machine and its life is over, we are getting salvage value 5,000 and working capital will be recovered to the extent of 10,000, which is relating to this replacement decision. And both these things will happen in year number 5. Now with that, we have got cash flows under both existing machine and replacement machine. And now we have to see how does it look taking into account the discount rate of the company. And it is told in the problem that take the net cash flow. We have got 2,04,000 in the first year under old, 230 under the new. Incremental cash flow is 26,000, 1,54,000, 1,64,000, 10,000. Similarly, cash flow under the existing machine, cash flow under the replacement machine, we take the differential, we find that we have got 26, 10, 30, 40, 20 as incremental cash flow, and salvage value is also received and working capital is also recovered to the extent of 10,000. Incremental cash flow between the two is 1,41,000 over 5 years, including salvage and working capital. And we are told the company's discount rate is 15%. It is simple. We have to find out the DF. We are supposed to get the current value, that is present value. Present value is nothing but future value into discount factor. We have seen in the first year the discount factor will be 1 divided by 1 plus r to the power of n. R is 0.15. Even if you take a calculator and then see 1 divided by 1.15, you will get 0.8695. And what you need to do is simply divide it consecutively by 1.15. You will get these values to 4 digits. We can make it to 4 digits. Then we have these values of 1 divided by 1 plus 0.15 to the power of 2, to the power of 3, to the power of 4, 5, and last two are also in the 5th year. Therefore, the factor will be common in respect of year number 5 and the 3 transactions. And invariably in the exams you will be given the DF. In the event you are not given DF, you can easily calculate this by one stroke of a calculator. 1 divided by 1.5. Subsequent years, each output divided by 1.5, divided by 1.5, divided by 1.5. Last step is multiply the inflow by the discount factor, which is the PV. 22,000, 26 into 0.8695, 10,000 into 7561, 10,000, 30,000 into 6575, 40,000, 20,000, 5,000 and 10,000 all occurring in the 5th year. The discount factor is 4971. We multiply and the net present value of the income stream is 90,167. Now with what do we compare this? We found here when we took a decision to invest 85,000, that is 65 plus 10 plus 10, 85, and we recovered 25, that is 30 minus tax paid. Net our investment was 60,000. Though the cash inflow was 1,40,000, when we discount it and take the present value, the amount is 90,167. Effectively, the comparison is between 60,000 and 90,167. There is a rule that present value should not be less than our investment. Our investment is 60,000 net and our net PV, net present value, is 90,167. If we look into here, present value of cash flow is 90,167. Capital outlay is 60,000. Net present value is the surplus is 30,167. So long as this is positive, replacement project is accepted as NPV is positive. Means effectively we are saying it should exceed or be equal to our capital outlay. That way we have solved the problem. Calculate the net investment required by the new machine, which we found out it was 60,000. And if the company's cost of capital is 15%, we have discounted based on 15%. Determine whether the new machine should be purchased. Yes, the new machine has to be purchased because the net present value is positive, or the present value of the cash flow is higher than the capital outlay. The logic is replacement project accepted as NPV is positive at 30,167. This is a question from December 18 exam. It is a simple question for choosing between two exclusive projects. They have got an outlay and running expenses, each independently, and both projects are comparable in the sense they have got 8 years of life, each has got a salvage value, and the cost of capital or the required rate of return is 10%, tax rate is 50%. It is simple finding the cash flows, discounting them, comparing that with the capital outlay. Here we have to just see they have given one discounting rate for the entire period of 8 years. It has got a catch. When the inflows are uniform over 8 years, we can take the total of inflows and multiply by the average inflow into this rate. Means if you receive 1 rupee each for 8 years, its discounted value will be 1 rupee into 5.335. And they have also given for the 8th year a separate rate. It has got something to do with the salvage value. Let us get going. Zenith Limited has to choose between two mutually exclusive projects, Project A and Project B. Project A requires an outlay of 10 lakh rupees. Therefore, the cash outflow will be 10 lakhs. It has got a cash running expenses of 3,50,000. Let us take it just to make a note of it, 3,50,000. On the other hand, Project B will cost 15 lakhs, outflow is 15 lakhs, and require cash running expenses of 2 lakhs. Both projects have got a life of 8 years. Project A has a salvage value of 40,000, which is received at the end of 8th year. Project B has a salvage value of 1,40,000. Means 10 lakh minus 40,000, 9,60,000 has to be recovered as depreciation over 8 years. Means annual depreciation is 9,60,000 by 8, 1,20,000. Therefore, the charge as per information given to profit and loss account will be running expenses and annual depreciation for the sake of comparison. Coming to the other side, 15 lakhs outflow, salvage value is 1,40,000. Therefore, depreciation over 8 years is 13,60,000. When you divide by 8, annual depreciation is 1,70,000. Therefore, your charge to profit and loss account is 3,70,000 and 4,70,000 in respect of A and B. The company's tax rate is 50% and its rate of return or cost of capital is 10%. Let us go further. We have derived the expenses. We have no other information with us. Our template always says take profit before tax, tax it at the given tax rate, derive PAT, add non-cash expenses or depreciation, derive the cash flow, and between two cash flows find out the incremental cash flow. The same thing we are going to do here now. We are charging to profit and loss account 4,70,000. Without taking any other transactions, our profit before tax will be the sum expenses of 4,70,000. Therefore, it is negative 4,70,000. What is the tax? Tax is 50% of it. 50% is 2,35,000 for all the 8 years uniformly. Then PAT. PAT is nothing but PBT minus tax, means minus 4,70,000 minus of minus 235. Therefore, our PAT will be 2,35,000 net. 50% goes to tax, 50% persists. To this, we are going to add depreciation. Depreciation is 1,20,000. Therefore, when we add these two, our net cash flow in respect of project A is 1,15,000 negative throughout the 8 years. Coming to project B, our expenses is 3,70,000, 50% depreciation. PAT is 1,85,000. Once again, same logic. Add back depreciation of 1,70,000 and you have got cash inflow of 15,000. 185 plus depreciation 170 is minus 15. It is minus 15 versus minus 115. Means if you calculate net, every year we have got 115 minus 115 minus 15 is equal to plus 100 is the net cash inflow. And the incremental inflow in respect of project B is 1 lakh each for 8 years. And what we have seen is if 1 rupee is received every year for the 8 years, the multiplying factor is 5.335. For this total, it is 1 lakh received every year for 8 years. The multiplying factor is 5.3349 or 5. The net amount is 533,493. We have also received a salvage value of 40,000 in respect of the first. In case of second, the salvage value is 1,40,000. Net difference is 1 lakh. This is received in addition to the 8. And what it says, for the 8th year, if you receive something in the last year or 8th year individually, not related to the balance 8, discount rate is 0.467 or 0.4665. Total amount will be 46,651. Means we will be having a net present value of 533,493 plus 46,641. Let us get going and let us see now 533,46 present value of cash flow incremental is 5,80,143. Our capital outlay is option A, it is 10 lakhs. Option B, it is 15 lakhs. Net outlay differential incremental in respect of project B is 5 lakhs. You invest 5 lakhs more and you get an inflow of more than 5 lakhs, 5,80,000. Net present value is 80,143. Project B. Since the incremental value is favoring project B is accepted as NPV is positive at 80,143. Now, this is a shortcut in exams because this question will normally have 7 marks. For 7 marks, you can spend only about 13 minutes or 12 minutes. You need not have to multiply separately. They have given it straight away. Use this logic. Even you can validate this for your knowledge. We can take it 1 lakh 1.1 to the power of 1, 9091 divided by 1.1 divided by 1.1 divided by 1.1 till here, and 8th year it will be the same. You will get the same present value 5,80,143. This is in respect of projects which are exclusive but for a similar duration. Assuming depreciation on straight line method, there is no funds constraint. Ascertain which project should be accepted. These are the discount rates. Solve a problem by an incremental cash flow approach. We have taken incremental. Project B, costing more, its inflow is more. If you look into this, 8,80,000 is the inflow, negative, 20,000 positive. Therefore, here when we take the net, it clears the hurdle. Project B is accepted. This is a problem which is from June 2018, a simple and straightforward problem. The company has machines. One of the machine which was purchased in the past, it could either be sold or modified. That is the option. If it is sold, there is one clause here. Loss on sale of existing machine can be claimed as short-term capital loss, means the corporate tax can be applied to it as a tax saving if there is a loss. This is the point. Second point is, these problems carry 6 marks. We cannot afford to spend more than 12 minutes on them at the maximum. Let us get into the problem. Anurag Mills Limited has a number of machines that were used to make a product that the firm has phased out of its operation. Fair enough, it is an old machine. An existing machine was originally purchased 6 years ago. It was purchased 6 years ago and its original cost was 5 lakh rupees. And it's being depreciated by straight line method and its remaining useful life is 4 years, means 6 years gone, 4 years balance, means it has to be depreciated over 10 years and it doesn't have salvage value and therefore 5 lakhs has to be recovered over 10 years. Annual depreciation is 50,000. 6 years completed, 50,000 into 6, 3 lakhs. Therefore, return on value as of today is 2 lakhs. Let us proceed further. No salvage value is expected at the end of the useful life. It can currently be sold for 1,50,000. Its cost is 2 lakhs. It could be sold for 1,50,000 when we go for the replacement option. In such a case, we will make a loss of 50,000. When we make a loss of 50,000, we have to provide for a capital loss of at the rate of 35%. As the problem indicates, the company could make use of it as a normal loss. Corporate tax is 35%. When we sell it off, we get 1,50,000. And when we book the loss at 35%, we save tax to the extent of 17,500. And 17,500 also becomes a benefit to the company in terms of cash flows. Therefore, from the sale of the machine and booking of the loss, net inflow will be immediate cash is 1,50,000 and tax savings is 17,500. Now, let us take it further. The machine can also be modified to produce another product at a cost of rupees 2 lakhs. Means if the machine is not sold, we can modify it and its balance life is 4 years. And when you modify, you incur a cost of 2 lakhs. Means if you retain the machine and not sell it, you have to spend 2 lakh rupees as an outflow. And this 2 lakh has to be recovered within its balance life of 4 years, means annual depreciation will be 50,000. Then if the firm does not modify the existing machine, it will have to buy a new machine at a cost of 4,40,000. It will buy a new machine. No salvage value will be there. And the new machine would be depreciated over 4 years, means annual depreciation will be 1,10,000. The engineers estimate that the cost of operating, cash operating costs with the new machine would be 25,000. In the sense, if the cost is in case of the old machine 25, we are presuming it should be less by 25,000, means it will be vanishing. 25 cash running expenses. If it is 25 in case of first, it will be 0. If it is 1 lakh, it will be 75,000. The difference has to be 25,000. We can safely take it as 25,000 in case of the first machine, 0 in case of the second machine, to ensure that there is a gap of differential of 25,000 between the two machines benefiting the new machine. Now this is the overall summary, and here if annual depreciation has to be considered, depreciation of the old machine, after modifying it another depreciation of 50,000, these two put together will be depreciation in respect of the first option of existing machine plus modification. In case of new replacement machine, you have got 1,10,000 as your depreciation, and you will also receive proceeds of sale and the benefit. Net cash flow, net debit to profit and loss account, 1,25,000 versus 1,10,000, because if operating costs are 25 here, it will be 0 here. Difference has to be 25,000. And then net outflow 2 lakhs for modification. Here 4,40,000 on the new machine, 1,50,000 received on sale of old machine, tax saved 17,500, 2,72,500 is the outflow here, whereas 2 lakh under the old system. Net outflow is 72,500 when we go for option 2. Now, so much for the workings in respect of the details of the proposal. Then, taking these workings, we can see under PBT, 125,000 is the debit. In case of replacement, 1,10,000 is the debit. And tax at the rate of 35% saved, 43,750, 38,500. PAT is A minus B is 1,25,000 minus 43,750, 81,250, and here it is 71,500. After tax, we add the depreciation back, depreciation of 1 lakh and depreciation of 1,10,000. When you add, your cash flow is 38,500 and 18,500. And the incremental cash flow is 18,750 minus 38,500, 19,500 for 4 years uniformly. And we have seen when it is uniform, we can give the aggregate rate which are provided by the problem. Here it says at 15% for 4 years, the multiplier will be 2.855. And if we multiply, it will be 56,386. This is as per the problem which gives. Net inflow is 56,386 as the present value. And we have to see what is our outflow. Our outflow was 72,500, whereas our present value is the 56,386. And the logic is NPV, difference between the two has to be always positive. If it is negative, means you are putting in 72,000, you are getting back 56,000. It is not a good proposition. NPV being negative, replacement project is rejected, because the 72,500 we had seen here. And once we see that, we have advised the company whether the new machine should be bought or the old equipment modified. Assume the straight line method of depreciation for tax purposes, or loss on sale of existing machine claimed as a short-term capital gain. We have used all this information. Going by the incremental approach, it is not worth going for replacement. We have to go for modification based on the incremental approach of capital budgeting. We can also cross-verify it, but your marks of 6 doesn't provide for scope. But for your understanding, you can just see 1.15, 1 by 1.15, 8696 divided by 1.15, you get the same output. But it is always better to use the information given without getting into detailed calculations. Thank you so much. Thanks a lot.